Hi, my name is Fan Yang, your Chief Technical Strategist here at ForexMinute.com. You're watching today's Forex video briefing. We have just concluded the July 30 Wednesday session. The main fundamental risk today was the FOMC monetary policy statement. The US dollar has been rallying as US data in the second quarter impressed and was expected to push the FOMC toward an earlier rate hike than the mid-2015 timeline. However, there was nothing hawkish about today's statement. In fact, it hinted that even if employment and inflation were near what the Fed hoped to see, the economy might still require a prolonged period of low interest rates. Let's take a look at how the US dollar reacted by visiting the euro dollar, pound dollar, and the dollar yen charts. The euro dollar has been bearish throughout July, as you can see in this 4-hour chart, falling from 1.37 to about 1.3370 today before the market found support. While the FOMC statement itself was not hawkish, the fact is that strong data is making the Fed respond by trying to convince the market not to expect good data to translate directly to the rate hike. Essentially, today's statement might slow down the US dollar, but not reverse it. In the short term, we can expect the euro dollar to consolidate with upside risk toward 1.35, 1.3510, but there is still downside risk. Looking at the daily chart, there is still downside risk towards the 1.3295, 1.33 area, the lows in November 2013. The pound dollar was also bearish in July after establishing a high on the year at 1.7190. Again, after the FOMC statement, US dollar stalled and the pound dollar found support around 1.69, though it did break below it earlier in the session. If you look at the daily chart, you see that pound dollar is still bullish as it holds above its 2014 trend lines. It broke one that extends back to November 2013, but 2014 trend lines are broken. Are not broken, and the 100 and price is still trading above the 100-day simple moving average. We are at a level where both a bullish continuation and a consolidation mode would call for at least a short-term bullish attempt. So if you look at the 4-hour chart, we could look at this week's highs around 1.70 as a possible short-term target, as well as up to the 1.7050 area. You see this support resistance pivot area. Okay, but if price moves above 1.71, we are likely in bullish continuation. If the market stays in consolidation and breaks below 1.69, then the market opens up. Then it would break the trend lines, first of all, and it would open up the 1.67 lows from May and June here. The US dollar Japanese yen pair broke above a descending triangle resistance earlier after the better than expected US GDP data for the second quarter. However, after the FOMC statement, the dollar yen is stalling at a common resistance area for April through May and June too. Again, today's FOMC statement can hold back the US dollar in the short term, but if the dollar yen comes back to about the 102 area, look for buyers. You see, this is sort of the central pivot of the consolidation we had since April, and it's where all the moving averages are clustered. So if the market is indeed turning bullish in the short medium term, it should find support around 102. A break below 102 would put the focus back toward the 101 to 101.10 lows on from July, as well as the 100.75 low on the year. However, if price can stay north of 102, look for it to push against 103 again and open up towards 104, 104.13 highs from March, April. And that wraps it up for today's Forex video briefing. Once again, I'm Fan Yang, your Chief Technical Strategist here at ForexMinute.com, wishing you safe and good trading.